George, you've literally studied China for decades, and I want to focus on something that David was picking up on, and that's those special purpose bonds that states can issue. That's kind of separate from the government's balance sheet. Is there a concern that China will actually overheat?
Alex, I don't think there's a concern about overheating at the moment. I think the issue really is that the slowdown is so ubiquitous and so kind of pretty deep-seated, actually, that I think that what the government is promising to do looks like, I mean, I actually do think they can stabilize this downturn in time for the 70th anniversary of the founding of the People's Republic in October, which is quite an important calendar date for them. But I don't think it's going to spark an economic revival. In fact, nobody doubts that the Chinese government can throw money at the economy in ways that, a lot of Western governments can't or choose not to. But that's not really the issue. The issue is whether it's really going to improve, overall economic performance and get the economy growing on a sustainable path. I still think their policies are conflicted.
So, George, one of the questions is how much debt are they taking on? And they certainly say they're going to keep it to 300% of GDP. But that doesn't count, as I understand it, these special loans made to municipalities for special purposes. Is there a risk there? It's like over $300 billion they're going to take on, it appears.
Yeah, I don't think we should be kind of fooled into thinking that the limited rise in the official budget deficit, so-called from 2.6 to 2.8% of GDP, is anything like what's going on. So if you include also kind of increases in special funds, and particularly in the off-budget financing of local governments, particularly in these financing vehicles that were set up several years ago, the special bond issuance actually allowance is pretty much double what it was in 2018. And as David Inglis reported, it's at over $300 billion. And, this is infrastructure spending off budget, which is not included in the official numbers. So the fiscal stimulus actually is of a pretty decent proportion, to be honest.
So, Walter, what does that mean for you in the market? How much risk does this mean you take on?
Well, I think China's the key to the world, right? I mean, it's the largest trading partner with Europe. Europe's close to a recession, so the world needs China growth to stabilize. They are throwing literally not just the kitchen sink, but the kitchen at the problem, and they'll likely be successful at stabilizing growth. But I agree with what George said in terms of they're not at risk of overheating. They just need to stabilize the growth rate over there and help the world kind of turn out of this slowdown that we've been seeing really for the better part of a year, starting early actually in 2018. The U.S. is just kind of catching up with that slowdown. So we're encouraged by the steps they're taking. They are taking significant risks, as we just alluded to, with additional debt. And that's a risk down the road. But for now, we think they're doing the things they need to do.
George, what, if anything, can we read into President Xi's position right now? It's certainly different from what it was a year or 18 months ago when it seemed like he was just totally in command. Now there is some criticism, at least. And even in Li Keqiang's remarks, he blamed a lot of the problems on the U.S. trade dispute. Is President Xi in as strong a position as he was a year ago?
It's an interesting contrast, isn't it, David? Because, as you say, a year ago he was being hailed as unassailable and omnipotent, and term limits were abandoned for the president, and so on and so forth. And it's a year which has been very difficult, I think. I mean, he has encountered quite a lot of disquiet at home from actually some of the state council members, as well as from leading intellectuals, about his approach to the United States and policies being pursued. And of course, the external environment has become more hostile, although we'll see what happens shortly before the summit meeting between the two presidents, which is scheduled at some point. But he is a bit more on the defensive. I mean, I don't think he's in any way at risk at this point in time, but certainly more on the defensive. And I think one of the things which actually has happened, I mean, these may be just optics really rather than anything of substance, but at no point in Li Keqiang's work report to the Congress did you hear the phrase "Made in China 2025," which is the government's keynote kind of industrial and technology strategy. And I think they are kind of keeping that rhetoric on very, very low, actually, for fear of antagonizing Washington and other Western countries. So there is a kind of sensitivity there, which I think is it's interesting to monitor. I'm not sure how meaningful it is.
Yeah, and then to wrap that point up as well, I mean, they also pledged to keep FX generally stable and at a balanced level. Is that also throwing a bone, in essence, to the U.S.?
Well, I think this is kind of interesting. They say that they want to keep it stable, but also there was another statement in Lee's speech about flexibility. So you can't really do stability and flexibility at the same time. I mean, at the moment, obviously, the RMB, or the yuan, is enjoying a bit of a kind of a purple patch, largely because I think the dollar's overall situation has obviously pulled back a little bit from where it was last year with the change in interest rate expectations and so on. But I wouldn't really trust that very much. I think the RMB is still very kind of depreciation prone. But maybe for a short while at least, I think it looks to be, it's certainly not under pressure at the moment.